Okay, welcome everybody. And today we've got GREG Foss and James from Bloomberg to talk about the massive announcement that was made earlier today, but also the one that was made just a few days ago regarding BlackRock with their partnership together with Coinbase to offer Bitcoin to their institutional customers. Greg, James, welcome to you both.
Great to be here, Archie. Thanks for having me.
Yeah, happy to be here too. Thanks.
Thanks for making yourselves available at such late notice. Greg, I'll start with you. What do you make of the two announcements so far? They seem to have sort of come right out of the blue, with BlackRock long being a skeptic of Bitcoin, or skeptical towards Bitcoin, with their attitude, regarding ESG, cryptocurrencies in general, but also Bitcoin specifically. And that seems to have done a complete 180 gradually without much notice. And then bang, here we are. They're right into Bitcoin. What do you make of that?
Yeah, so great question. I can only say that it's not surprising, given my experience with asset management firms that have to compete, right? So the reality is Fidelity has been a trailblazer in this area for many years, right? Now, and in terms, so the audience understands, BlackRock is the world's largest asset manager, and Fidelity is in the top five. Okay, but Fidelity is more, active, whereas BlackRock has a lot of ETFs called passive management. But leaving that aside, Fidelity has been quite vocal in recent years, more than a few years actually, on the Bitcoin front. And they have one of the seminal pieces in research for institutional investors that I have seen, which is basically a Fidelity report that covers digital assets from soup to nuts. And basically, I'm paraphrasing the conclusion in Foss speak, but their conclusion is there's Bitcoin and then there's shit coins, and they didn't use that word, and I apologize for swearing, but I mean it summarizes it nicely. So Fidelity's been out there. They've been mining Bitcoin. Abigail Johnson, the CEO, has been mining Bitcoin and researching Bitcoin for many years now. I think it's been since 2013 or 2014. So Fidelity's out there with the research. They announced that they are allowing clients 401k allocations to Bitcoin. And in a competitive market, it is not surprising that BlackRock has responded by offering similar sleeves, if you will, for their clients, because the clients are asking for it. So in a competitive market, you can choose to listen to your clients, or you can refuse to listen to your clients and lose your client to the other platform that offers this up. So it's a competitive response. I can only say that, yes, it is an about face for an ESG trailblazer on one side, Mr. Fink. But that being said, perhaps he's peeled a few layers of the onions and realize, that Bitcoin and Bitcoin mining can actually be very ESG friendly. That's a low likelihood outcome, not outcome, but probability. What the reality is, very simply, supply and demand competition for clients who want to diversify their risk portfolios. And here's how I'll summarize it very succinctly for the listeners. The 60/40 portfolio has been crushed. Now, 60/40 for people, I'm pretty sure most people know, but 60/40 portfolio is a traditional balanced portfolio where you have 60% of your portfolio in equities and 40% in bonds. And the first time in the history of 60/40 asset management has the NASDAQ and long bonds been down double digits in the history. So that means that the 60/40 portfolio got crushed the last 6 months. Obviously, there's active managers out there who are going to offer diversification benefits, which include potentially non-correlated assets. And it's my belief over time, Bitcoin will become a non-correlated asset as a effective insurance policy. But for the time being, stick with me. It's as simple as 60-40 is dead. A lot of people have said it. You better get your product offering up and more diversified, especially since clients are asking for it. And if you're not competitive, you're going to lose the #1 spot in global asset management, which is $10 trillion of assets, AUM, for BlackRock. And, they got there by listening to clients and being good at what they do. So long-winded answer. But it's nothing more than the competitive juices flowing in capitalism. And I just, for a little history, Arch, I basically saw the same thing happen in Canada with an asset class which was perceived as a pejorative at the time, called junk bonds. Well, lo and behold, 30 years after I started trading junk bonds in Canada, it is an asset that appears on every, and I underline every single asset management platform in Canada now has exposure or a high yield bond sleeve. 30 years ago, there was one client in Canada that was a trailblazer. And, that's the competitive nature. So let's go, let's just go with that and use that as a roadmap. I know that Bitcoin's going to be far bigger than junk bonds, far bigger than high yield bonds. And it's a competitive market. There you go. Thanks.
Greg, just hold that thought on junk bonds, because I'm really curious to understand the adoption curve and the changing dynamics, how you experience those through the times that they became more popular. I just want to throw to James right now. James is one of the resident ETF experts at Bloomberg. James, what have you got to say about BlackRock's seemingly sudden about face? But of course, this has long been coming internally.
Yeah, so I would say, I mean, to summarize what Greg said, and I agree with probably the majority of what he said, the customer is always right. And BlackRock is going to do whatever they think can make them money, as long as it's not completely against the ethos of things that they believe in. And our team has long thought that BlackRock and others were eventually going to jump on board, and we've said that we thought they would launch a Bitcoin ETF when it is eventually approved. So we're not really all that surprised by them doing this. They've launched what we look at if you look at the ETF market, there's a bunch of ETFs that we call them thematic crypto or thematic blockchain ETFs. And they basically invest in equity securities of things that have exposure to the blockchain technology or crypto in general, or Bitcoin specifically on their balance sheet. And it's basically a way to get exposure to crypto in the US because we still don't have a spot Bitcoin ETF. Now, BlackRock launched one of those not too long ago. So we already knew they were looking at the space. They're going to move on anything they think they can make money on, essentially. And then the other thing which hasn't been discussed that I think is coming is Schwab just launched a blockchain thematic ETF, which is going to be critical because we keep seeing all these issuers launch this and then start diving in. And for them to compete, like Greg said, with Fidelity, all these other issuers, Robinhood now has crypto. We think Schwab, who just acquired TD Ameritrade, is also likely going to have to start taking a serious look at how to get into this space and offer things like this. So all these issuers, they don't have a choice because, like Greg said, customers are going to have to go somewhere. And if they do want this, the customer is always right. And if they can provide it in an efficient manner, they're going to do the best that they can to do it. So, I mean, this is not shocking to us in the grand scheme of things, I would say. I would have bet on it happening. I don't know if I would have bet on it happening this quickly. But I'll just stop there.
So just to give our audience a little bit of context, I'm going to read out the rankings of the top asset managers in the world. So I'm reading this list off Wikipedia right now, and the top 5 manage a combined approximately 35 trillion US dollars. Okay, so BlackRock is number 1 at 10 trillion. Charles Schwab is at 8.1 trillion. Vanguard is at 8.1. UBS at 4.3, and to round out the top 5, it's Fidelity Investments, which is at 4.2 trillion. Now, of those 5, Fidelity, from what I've been aware of, have been the most active and bullish in the Bitcoin space. James, I wonder if you can give us some comment on why BlackRock came out with a private fund and not a public fund like an ETF.
Well, they they won't be able to get a public fund approved. I don't think they want to go in futures wrapper. There's already enough futures ETFs in the U.S. I think they would launch a spot Bitcoin ETF when the SEC does approve it. Now, when that's going to be, I don't know. We think late 2023, potentially mid 2023, but we're not holding our breath. So I think that it's very likely that Schwab, BlackRock, all these guys are going to eventually launch these things because it's capitalism and they're going to compete and they want to get the most assets they can. The other thing we talked about AUM. So BlackRock, Fidelity, all these guys manage money, but Fidelity and Schwab and these other issuers also are they custody assets for advisors and other people. So they basically just need to be able to have a platform that allows people using their platform to get access to whatever they want to. And if people want access to Bitcoin and they're a customer of one of these industries or one of these companies, and they can't get access to something they want to, and another company is offering access and it's comparative price and it does everything else they want to, they're going to lose customers. So it's kind of they're not going to have a choice but to enter this space strategically to make sure that they don't lose customers, and it's potentially a growth area for them as well.
So it's interesting both of you have mentioned competitive pressures, because some time ago I went through the list of top 5 custody banks in the United States, and they all offer digital asset or Bitcoin custody from now on. They're already offering that to their customers, or they've got those services about to be launched. So that's an interesting thing to see. So of the top 5 asset managers now, we've got BlackRock clearly into Bitcoin, Fidelity Investments having long been in Bitcoin. And so how long do you think the competitive pressure will result in pretty much every fund manager in the top 10 or so by necessity having to be into Bitcoin and offering it to their clients? Because I want to quote something that I found from BlackRock earlier today, and I'm just going through my tweets. There is substantial interest in Bitcoin from institutional clients, despite the steep downturn in the market. Now, BlackRock manages 10 trillion, as I said, but the top 5 manages 35 trillion. If there is such persistent demand from the most conservative investors, how long before the rest dive headfirst into Bitcoin?
Well, I'll jump on that, Archie, as basically it's borrowing Michael Saylor's terms. It's going forever. Okay, it's just the way when you run competitive asset management platforms, you have to have a silo for the clients, or else you'll lose the client to the platform that offers all the silos. And let's be careful here. This is, yes, 2 of the top 5, but there's a distinct difference between the active management offerings and the passive management offerings between the 2 platforms. Okay. Basically, a lot of the BlackRock clients are people that like the low fee nature of passive investing. That's to say the ETF side.
Greg, can you just break that down to us? What is passive and active investment? What is, just really quickly, so we're all on the same page?
Sure. Yeah. Passive investing is buying an ETF where there's low fees, and you can mimic the S&P 500. Active investing is saying I'll own the large cap stocks, but I don't have to be long a Western Union, for example, which is in the S&P 500, because that stock is going to zero. That's a FOSS prediction. It's not BlackRock's prediction or Fidelity's. But the reality is, since it's in the S&P 500, BlackRock owns it. But an active manager, or a S&P type offering, large cap type offering, the analyst who actually does work, rather than a passive manager who just buys something mechanically based on an index weighting. The active manager might say, why would I own something with an outlook that has a Western Union type of outlook, where basically they're, robber barons charging fees that now can't compete. So I use Western Union. Forgive me, Western Union, but yeah, you're going like Blockbuster. It's just the way shit happens. So here's you have that. You have, but that's from clients who have listened to the Vanguard mantra that the only difference over time is fees, and the lower your fees, the more you can capture in performance. I, as an active manager, my whole career, will take issue with that. But that's the way the world is split up: active management, passive management. Fidelity much more active than your traditional BlackRock. And if I could add something, and I want to say, James, well said. Okay, I've never met you before. You've spent some time in the ETF space, and I'm not knocking the ETF space. Okay, it is a valuable method of allocating capital quickly over a broad base that some of the big institutions cannot afford to do, or gain exposure to individual companies. They need to get an index. But here's the crux of the whole matter when it comes right down to it. Okay, ETFs are somewhat un-American. Okay, and I'm a Canadian, so you guys send the hate mail. But if you guys think that investing in a passive index that has weightings allocated by market cap is a great way to follow the herd, you're basically allowing zombie companies to survive just because they're in the S&P 500. And I don't want to redirect this whole conversation, but there's a lot to be said about managers who are able to short stocks, managers who are able to call out some of the weak parts of the investing spectrum, including why would you own the equity of a company, but you wouldn't own a bond of the same company? And why would you own the equity if you don't know where the bonds are pricing the risk of the same company? Well, welcome to ETF investing land, people. I'll buy it because it's painted across an S&P 500 portfolio, but have no idea where the debt of a lot of these companies are trading. And the really smart people know where the debt is trading and say, why would I buy the equity, a subordinate claim of this company, if the bonds are telling me the company's in financial distress? I mean, these are some of the things, guys and ladies, that you need to do when you do real research in a capitalist system. Okay, there's a reason that a capital stack exists, and it's not for ETF clown investors to pile into just because I need to get exposure to the index. So sorry to rant a little bit, but here's the truth: you got to do your work.
James, do you have anything to say to that before we move on?
I mean, there's a lot I could say to it. All I would say is that we're almost at 50% passive in the U.S. funds world. The math is undeniable. Most active managers, somewhere about 80+%, lose to the passive benchmarks. So you're just betting on average, essentially. And I'm not somebody who's against active management. I obviously invest in it to an extent. So I would just leave it there. I would also add that Fidelity's, the fastest growing area of Fidelity's business is passive management. They're one of the largest passive managers. There's only one company with more passive index fund AUM than Fidelity, and that company is not BlackRock, it's Vanguard. Fidelity has more passive AUM than in their mutual funds than even BlackRock does, only beaten by Vanguard. So I wouldn't classify Fidelity as more of an active manager, though their history is in that where they're growing and going towards is more towards the passive side of things. And again, I just think that's just part of the way that invest. A lot of these ETFs are they're not some of them are held passively, but for the most part they're used actively. So you're going to invest in a certain sector equity ETF or US equities, and you might short another ETF that does something else or whatever. So there's tactical moves around the exposure and portfolio allocations. And when you can get exposure to the entire US stock market for 2 basis points, it's too good of a deal for most people to pass up. And the
James,
numbers and flow show it.
Sorry, yeah, brother. Listen, I'm not coming out at you by any means. Okay, look, one of the reasons that the average manager underperforms his or her benchmark, is because that's what a market is. Okay, a market is made up of all the people out there that are competing in the market. So let's bring this back to the Bitcoin conversation and not the Foss rant on ETFs, because it's not about that. Okay, what it is about your clients asking for a product that you need to deliver. If you don't deliver it, then you're gonna lose to the competition. Fair enough?
Yeah, I think
Agreed.
that's a point well made, and we can take it from there. Greg, you mentioned earlier about junk bonds and your experience as a trader. You're a bond trader with 35 years experience, and through the time of your career, they were pretty much, as you said, a pejorative. But then gradually, attitudes towards junk bonds started to change. Can you tell us a little bit about when you first started noticing attitudes changing? Who were the players? What were the dynamics present? And then how did that sort of progress from there? Who were the next in line to get into junk bonds, and how did they gain exposure to that? And can you see any analogs with Bitcoin?
Well, the analogs with Bitcoin are only going to be at the top, the highest level, which is, the diversification benefits of a separate asset class with different correlations. But let's look at what a junk bond is to begin with. It's a pejorative because yes, if the bonds are junk, let's consider what the equity is then. Well, the equity is super junk, right? Pejoratives aside, equity is more risky than the debt because in the event of a restructuring, the bonds have prior claim on the capital structure, on the assets. So there was a time in Canada, for example, and this is a true story, all right? The largest high yield borrower in the world, not in Canada, the largest high yield borrower in the world was a company called Rogers Communications. Now, Rogers was a cable and wireless provider in Canada that issued over 4 billion. It sounds like, mice nuts in terms of numbers right now, but 4 billion at a time back in the late 80s, early 90s was actually a lot of money, okay? And Rogers had 4 billion US dollars worth of debt issued into the high yield market, even though it was a Canadian cable and wireless provider. And the American investors, most of the new issue high yield investors lived in the USA because of Michael Milken. And they were able to look at Comcast and say, wow, I can see the credit metrics of Comcast versus this other company called Rogers Cable Systems or Rogers Communications. And you know what? I actually like Rogers better. And that being said, I like it better from a credit risk perspective, but they're paying me higher yields than I would get on Comcast because it's a Canadian company that has no choice but to fund themselves in the USA. So I'm sitting in a chair in Canada and I'm trying to develop Canadian demand for Rogers Communications debt. We wanted to issue Canadian dollar denominated Rogers Communications paper because there is no US revenues of Rogers Communications to offset their US dollar debt structure. So they'd have to do interest rate swaps through the Canadian financial institutions, tying up more credit, etc. But here, focus on this. I hit the key. I call up the largest owner of Rogers Communications equity in Canada, owned $900 million of Rogers Communications equity because it was in the TSX 60, the largest 60 companies in Canada, and they owned 900 million of it. And Rogers Communications paid no dividend, and the debt for a number was paying about a 10% annual coupon. Yeah, it was high yield. I say to them, hey, you own 900 million. How much can I put you in the book for? 0. Why? Because it's a junk bond. Okay, pejoratives aside, I ran through this with you guys. You own super junk equity. Yeah, but it's in the TSX 60. I got to own it. So I said, well, let's play a game. Why don't you sell some of your equity, buy some of the bonds at a 10% yield, move up in the capital structure, treat the income on the bonds like the dividend you are not getting on the common stock, and actually reduce risk and increase return by buying junk. I can't do it. Why? Because my board of directors would tell me I owned a junk bond. So I say, okay, obviously it's the 10% coupon that you don't agree with. What price would you buy the bonds at, Arch? The trader, the portfolio manager says to me on the phone, we would not buy it at any price. And I said, let me get this straight. If I gave you the bonds for free, for 0 cents on the dollar, she says, I would not take them. Or it doesn't matter whether it's a she or he. And then the salesman who covers that account knows that I'm getting frustrated because I'm the trader. And I start saying, you're the most foolish asset manager I've ever met in my life. How could you possibly not take something for free? Anyway, then the salesman's hitting the key. Foss, get off this account. You're going to destroy my relationship. But the point is that they would not even buy a senior claim in the capital structure because it was something pejoratively described by the press as a junk bond. And having lived in the trading pits for my entire life, you know, like I do, there's a price for everything. So drawing the parallel to Bitcoin, well, everything you read in the press is that Bitcoin is bad. Hey, guess what? People are actually doing some work. And that particular big institutional manager that owned 900 million of Rogers Communications common stock now has a high yield fund that they can allocate Rogers Communications debt in one sleeve, as well as owning Rogers Communications equity in another sleeve. It's part of an efficient market, part of a developed risk allocation strategy. And as you, perhaps I'm going on too long here, but 30 years ago, there was one account in Canada that did it. And all the other accounts lived in the United States, okay? And it's not possible that that account in Canada was big enough to fund itself, to fund all of Rogers Communications' demand. It wouldn't have been possible. It wouldn't have been, there'd be no one to trade with. But here's what I know now. Rogers Communications debt is now owned by pretty well every single asset manager in Canada. Hey, and also a little side note, shout out to my friends at Rogers Communications. It's no longer a junk bond company, people. It's now what's called investment grade. Thank goodness they got the investment grade credit rating bestowed upon them by those magical rating agencies, Moody's and S&P. And Rogers funds themselves entirely in Canada in Canadian dollars. Part of the whole evolution here, I know it's a long drawn out story, but I've lived it. And I tell you, it takes time. But education is key. And when the competition is doing it, you better do it or you lose your client to the competition. Thanks.
So, Greg, this to me feels like a seminal moment in, I guess, removing corporate risk for fund managers to actually get into Bitcoin. Was there a similar occasion with junk bonds that you recall?
Yeah, no, you know why? Because money flowed there. That high yield fund was showing double-digit returns when investment grade funds were showing substantially lower returns. That's fine. Investment grade is less risky, therefore should have a lower coupon than high yield. But here's the greatest thing. High yield bonds of Rogers Communications outperformed the equity for 10 years running. Isn't that amazing? That you got a better return for lower risk with Rogers Communications debt than you did by owning it as part of the TSX 60 index in Canada. Lower risk, higher return. Call me crazy, but that's sort of what I look for my entire life. So there's the analog right there, or analogy rather, sorry.
So there are two things that you touched upon. First of which I just mentioned about career risk. And the second, which I want to throw over to James, is that institutions need an appropriate vehicle through which to invest. James, can you comment on why funds are so popular amongst institutions rather than direct investment, especially now that there are actually institutional level custody options for them? Why do they still prefer funds?
Well, so at the institutional level, they don't necessarily prefer funds. They'll often have what are known as separate accounts or separately managed accounts where it's just somebody else custodying it. So, like, there's never been anything in the world like there is Bitcoin where an institution could custody it themselves, theoretically. There's also a lot of firewalls built in place to kind of force you to have a third party to make sure there's no, if you will, janky accounting going on or stealing of money. So basically having all these different people involved, accountants, custodians, these different things is for protection of the underlying investors. So institutions who are doing this, theoretically a hedge fund or private equity fund could obviously hold their Bitcoin or crypto, whatever they wanted on their balance sheet. But for compliance reasons, it's going to be way easier to just put it into one of these separate managed accounts or one of these custodians. Now, from the ETF perspective, like what where I mainly cover is just when you got to break out institutions and advisors. Advisors control $20+ trillion in AUM in the United States alone. So institutions obviously control many trillions of dollars as well, whether it's wealth, pension plans or sovereign wealth funds, whatever it may be. How they get access, we won't know. But advisors, they want their access via ETFs. So institutions, they might choose some of these private fund vehicle structures, especially if they're cheap and easy to get access to. But there's no way to know exactly how they're going to choose to do this. I think that a lot of them are going to choose to use a trusted third party to hold their crypto, just because it's safer from them from a compliance perspective and a CYOA perspective. Cover your own ass. They don't have to worry about losing the keys if they hire somebody else to maintain it. And then there's legal liability for somebody else doing it. So for all those reasons is why somebody would hire somebody else to maintain the ownership of whatever digital securities they're holding, whether it's Bitcoin or some other version of crypto.
Now, some time ago, it was the head of BlackRock, Larry Fink, he wrote a letter regarding ESG to a lot of the CEOs of the largest companies in the indexes. And that was taken as a signal to every company that, if they wanted the support of BlackRock as an investor, they had to get with the game on the ESG game. And a particularly notable example was when Elon Musk bought Bitcoin through Tesla. I think he bought $1.5 billion at the time. And it was rumored that a discussion with the head of BlackRock put some pressure on Elon, which resulted in, the liquidity testing example, and also withdrawing the ability of customers to pay for Teslas with Bitcoin. So do you take this position from BlackRock now as removing any kind of taboo in the corporate world and the fund management world regarding Bitcoin?
I don't think it removes that taboo. I think there's still plenty of people that are still concerned about that. But I think, Bitcoin has fallen so far that people are just interested to buy in now. We know for a fact, I've talked to plenty of institutions and plenty of people at these institutions who like Bitcoin and blockchain technology and want to get exposure to it. So from that perspective, it has slightly changed, but for the most part, there's still going to be people that view Bitcoin as using too much energy, being bad for the environment, no matter how much research you show pointing to the alternatives, showing them helping to stabilize the grid, whatever it may be. So I think there's just going to be more and more research out there that's going to kind of set the record straight, if you will. So I don't know that this necessarily automatically makes it okay, but it certainly makes any critiques coming from BlackRock and Larry Fink a lot less valuable. In the same way that JP Morgan and some of these other companies whose CEOs don't like Bitcoin, but now their companies are offering it for the private wealth management platforms. It just kind of makes their bark with no bite kind of thing, if you will.
Yeah, that's a really interesting comparison, because it seems to me like at JP Morgan, what's his name? What's the head of JP Morgan's name?
Jamie Dimon.
Yeah,
Jamie Dimon.
Yeah.
He seems to have been swept to the side with respect to Bitcoin, and he doesn't really comment on it too much. But the rest of his business is unambiguously bullish on it, and I think they're pretty much heading straight into Bitcoin as well. I know that they were extremely skeptical, to the point where one of his quoted comments was, "I'll sack anyone who touches it." But that's no longer the case. You mentioned that in your discussions with various people at institutions and investment organizations about Bitcoin. Are they more personally bullish, but just, I guess, frustrated with the organizational inertia to push ahead, or are they a little bit tentative regarding some of the sensitivities internally?
I would say that classifies it. There's a lot of regulatory uncertainty, which is a term you'll hear a lot. It sounds like we're going to get a lot more regulatory certainty over the next year or so, with some of the stuff happening in Congress, with the SEC cracking down on some of these things that I personally believe are securities. So we're going to get some more clarification. And I think once we get more regulatory clarity, these institutions, these asset managers will be more likely to come on board and use crypto if they want to. Obviously, there's going to be plenty that still don't want to touch it, but the regulatory uncertainty that exists in the market still to this day, and there's a bunch of different other black clouds hanging over the industry still, even as it is, that are keeping people out. But as it grows, I wouldn't be surprised to see some of these institutions jumping on board. Like I said, there's at almost all these institutions, there's somebody involved at different levels that enjoy likes Bitcoin and thinks it's a positive thing, or wants to invest in it, or thinks it should be involved in the company, whether it's on your balance sheet, whatever it may be. It's just there's way too many hurdles before to do that. Obviously, things like Square and MicroStrategy are the exception, not the rule.
Yeah, we've heard about regulatory uncertainty a lot. That term has popped up quite a lot amongst people who have a deep understanding of what's happening in the corporate and institutional world. Michael Saylor's spoken about it. What's his name? Kevin O'Leary has spoken about it. Lots of people continue to mention that there is a flood of money waiting to enter Bitcoin once there is regulatory clarity. What does that actually mean? What are they waiting for from regulators before they feel comfortable investing in Bitcoin? Because retail can do it. Why can't they?
Oh, can I? Oh,
yeah, I was
go
gonna
ahead.
Say, I was
go
gonna
ahead,
say,
James.
I was gonna say, let Greg go. I've been talking.
Oh, I
Go ahead,
appreciate
Greg.
it. But okay, so no, we'll go back to that because, but let me add, because this is, James will be more informed, but regulatory, a degree of regulation will be very positive for the adoption of digital assets. And let's be clear here, all right? There's only one use for a blockchain, in my opinion. So let's not conflate this with blockchain technology and all that. Intellectual laziness is pervasive anywhere. Jamie Dimon probably knew what he was saying, but understood that he could be disintermediated by the Bitcoin payment rails and etc. So he had to say that. Well, he didn't have to say it, but he said it as a defense of his own TradFi platform, if you will. I wanted to talk about the institutions that have been doing the research, because not every institution, and particularly family offices, a lot of them are way out in front of the curve. And they've been doing the research. They need to understand liquidity within the markets. They need to understand the regulatory environment. But a price drop like this is attractive, particularly if they were, kicking themselves for not being able to get involved in Bitcoin at higher prices. And in my opinion, the prices right now are still a rounding error. It is a mathematical exercise to figure out your own price targets on Bitcoin. And a lot of these big funds are doing that. Particularly, again, I'll have to go back to the unattractiveness of bonds in an environment where you have 8%, 9% CPI, and nominal yields on 30-year treasury bonds are 3 to 3.2%. I mean, hard to square that circle in my chair, having been a bond trader my whole life. Yeah, I really want to lock in a negative 6% real yields. That's a hard one for me to sell. But even if rates were at historical levels, much like in the Volcker area, when yields on bonds would approach the CPI, you have to realize that bonds are a fiat contract. And in an era where QE infinity is a certainty, that fiat contract is debasing. The $100 you get back after a period of 10 to 30 years is worth far less than the $100 you advanced at time zero. And these credit managers understand this, okay? It's pure mathematics. And that's what bonds are. Bonds are a mathematical contract. And that's why you can equate bonds and Bitcoin quite easily, in my opinion. So coming full circle here, people, there's people that are doing the work on the institutional side, and I include family offices on that front. Those are larger advisory services for wealthy families, etc. And even the RIAs out there that are doing the work, a lot of their firms don't even allow them to invest in this asset class. So although they themselves have clients that want to get involved, a firm like one of the banks in Canada does not allow the RIAs at that particular firm to buy Bitcoin of any kind, whether it's Bitcoin miners or GBTC, the Grayscale Bitcoin Trust, or the Canadian Bitcoin ETFs. Well, those financial advisors themselves are going to lose clients to other platforms that do. And this is how it dribbles down the whole spectrum. So with respect to Mr. Fink, the largest asset manager in the world, quite a smart man, there's no question, and his views on ESG, there will be people that forever believe the headlines they read in the New York Times, okay? Because that's what they are. Now, personally, I wouldn't wrap fish in the New York Times, okay? I think it's a very biased institution that does very little intellectual work. But there's other people that do the work. And as far as the ESG narrative goes, it is important to understand the truth. And more people will learn the truth. There will always be those people that believe that Krugman and the fax machine and everything that appears in the New York Times is gospel. But then there's people that aren't intellectually lazy and actually do research. This is happening at big funds all over the world. And that's what makes a market. You can be an ESG pro, you can be against ESG, and then you can realize, in my opinion, that Bitcoin doesn't fall or need to fall into either side. Bitcoin is pro ESG. Do your own work.
James?
Yeah, I mean, I'd agree with actually Bitcoin being pro ESG, especially with the social and governance side of things. And also, I think the stability of the grid and stuff, what's happening in Texas, will give us a good proving point of whether or not it's environmentally friendly. But that's up for debate, I guess. And I agree with pretty much everything you said. I know for a fact there's smaller family offices, private equity funds that got involved by trying to play those grayscale trusts, the premiums and things like that. So they not necessarily wanted to get involved and hold Bitcoin or digital assets, but they wanted to get involved so they learned about the space by trying to play those premiums and the discounts that are going on in the marketplace right now. And that has drawn a lot of people in. So there are a lot of institutions that are already involved in some way or another. And then the question really was about regulatory clarity. I think it goes back to the regulatory clarity of right now, even the SEC and CFTC are fighting over who has the right to regulate different markets in this space. I think Bitcoin is definitely going to fall under CFTC. There's a lot of other areas that are likely to fall under CFTC. There are a lot of these tokens that I would argue are securities, and the SEC is going to argue that more than the ones that they've already filed suit against Coinbase for. So there's all these different areas that that's the stuff that's still kind of up in the air. Who's regulating these markets? How are these markets going to be regulated? And I agree with Greg. Greg mentioned initially at the beginning that more regulatory clarity and more regulation is going to be a good thing. I know some people in the cypherpunk era and the libertarian area don't like regulation, don't want to see regulation in the space, but it's going to open up the valves for other people to get involved in the space. And quite frankly, it's going to open the valves for trillions when there is more regulatory clarity for people to put, even if it's just 1% of their portfolio. When you look at that on trillions of dollars, it's a lot of money that's going into digital asset space or Bitcoin directly. So the regulation, again, like Greg said, I view as a positive thing for the crypto space and Bitcoin, which I know will get me in trouble with some Bitcoin maximalists and different things, but I'll just stop there.
So
James, oh, sorry. Can I just say, well said, buddy. Look, the big money in the world is managed institutionally, and they need regulatory clarity. That's the way markets work. And by and large, there's a lot of very good regulation in the markets. Otherwise, you would have some very nefarious activities, more nefarious activities going on than there already is. And I wanted to take something that you brought up and expand on that. This is called the Grayscale Bitcoin Trust, okay? A closed-end trust, not ETF, that traded in the US market, still trades actively, but at one point, the premium to the net asset value of GBTC, the Grayscale Trust, was 100%. It meant that people were buying Grayscale Trust at a price double the value of Bitcoin that it held. And the reason they were doing that, there were a number of reasons they were doing it, but you can argue that not having a spot ETF at the time, and this was a $10 billion fund, there was $5 billion of funds that were allocated to an investment vehicle just because of scarcity that should have been more properly allocated to a spot ETF that would have reflected the price of Bitcoin on the daily closes, okay, with this redemptions and creation and redemptions of an open ETF. those are very good and solid functioning parts of a market. And incidentally, shout out to Canada. Did you know that Canada had the first ETF ever? Not just first Bitcoin
Yes.
ETF, the first ETF ever. Okay.
Yeah.
So I'm not negative on ETFs. I'm negative on people that blindly allocate to an ETF without considering some of the risks. But going back to, stick with me here. Now, GBTC, if I pull it up, is trading at a 30% discount to net asset value. All right. Shouldn't some large pension plan, like maybe Canada's largest pension plan, go in and buy all of GBTC to get their 1% exposure that they should have to Bitcoin? Just buy the whole thing and unwind it and take Bitcoin and hold it self-custody and all the good things that you need to do with Bitcoin, and arb the market from a 30% discount to net asset value right down to a 0% discount to net asset value. Hey, I managed billions, but I never managed trillions. But if I managed trillions, I'd be looking at that little cookie and saying, my goodness, I'm big enough to make this happen. I need the X% of exposure to Bitcoin to my portfolio. I might as well buy it at a 30% discount to begin with. So all of these things come around and go around, guys. Regulation is key. You got to look at both sides of it. But wow, GBTC is an example of an inefficient market in the USA relative to the spot Bitcoin markets that exist in Canada. So shameless shout out to my homeland, Canada, eh? Thanks, boys.
So regarding regulation in the United States, is it a battle for territory, or is it a hot potato between the SEC and the CFTC regarding Bitcoin?
It's definitely a battle for territory, and undoubtedly, Gensler wants to be able to say it's an open secret that Gary Gensler likely wants to become the Treasury Secretary of the United States. He wants to beef up his resume, if you will. He wants to basically be able to say that he tamed the Wild West of crypto. And I mean, everybody on here, you can't debate. There's a lot of really sketchy scams, sketchy people, grifters that are involved in this space. It's not the whole space. So that's what a lot of people see and hear about. They hear about hacks. They hear about people getting stolen from. They hear about all ripped off, all this different stuff. So the SEC, honestly, I don't think they've done enough in this space. They should have been going after people that with more obvious scams. I think they're far from done. I think the SEC is going to go after a lot of different areas of the crypto space. But it's definitely, you saw recently, Gary Gensler, when they filed the lawsuits against those the Coinbase employee for internal trading or insider trading. They also went after those 9 companies. They've gone after Coinbase for listing securities. The CFTC chairman actually wrote a public letter, a press statement, basically bashing the SEC for doing that, saying they don't have the right to go after and do what they're doing yet. Which you don't see. There's always been a lot of push back and forth between the SEC and CFTC. There's always been they're frenemies, if you will. They get along because they have to. But this is the first time we've seen it like pour out into the open, and that only happened last month. So it's definitely a battleground for it's a turf war, if you will. But time will tell to see who covers what markets. It's definitely going to be split between the two. We just don't. Again, it just goes back to the fact that we don't know how things are going to shake out.
So some things are self-regulatory. Self-regulatory, right? The SRO, self-regulatory organizations, which includes a lot of the asset management divisions in Canada, certainly. And here's the funny thing. Okay, look, I make no bones about it. I'm a Bitcoin maxi. Okay, I'm a Bitcoin maxi because I'm a fiat minimalist. And some people say Bitcoin maxis are the most evil people around, and the toxic Bitcoin maxis talking stuff about other, quote unquote shitcoins. Hey, that's part of a self-regulatory organization as far as I'm concerned, okay? And I'm not a toxic Bitcoin maxi, and I'm not telling you that there's not other uses of blockchain. I'm just telling you I haven't found any yet. And not that I'm a coder that needs to opine on every single use of blockchain versus centralized databases. But what I will say is, my God, the Bitcoin ecosystem is a thing of beauty, because not everyone has to believe and live in an echo chamber and say, these guys are good and these guys are bad. You can all have different viewpoints and you make the ecosystem better. This is dangerous, James. I'm just going to throw this out. The danger is a lot of people that get enamored with blockchain don't truly understand the subtleties of it. And then they say, why should I buy Bitcoin? Or rather, I can buy Bitcoin at 25,000 bucks, or I can buy this other coin, call it a Doge coin, just for example, at a fraction of a dollar. Oh, I'm going to put my money in Doge, because Elon Musk is a rocket scientist. Look, here's the thing. The way you learn is by losing money. And I just hate to think that these people are going to have to learn the hard way rather than have SROs, self-regulatory organizations that help to separate the good from the bad. Okay. Again, I'm a fiat maxi for all the good that the fiat maxis bring to the world. Now, there's some toxic Bitcoin maxis that I myself feel like I don't get along with. And that's just fine, because if you get along with everybody, you're living in an echo chamber. You're not going to make the right investment decisions. You always have to listen to people with opinions that are opposite of your own and who have done the homework, rather than live in an echo chamber to hear how smart you are. That's what Peter Schiff lives in, okay? He lives in his own little echo chamber, and he's given bad advice for everybody for the history of his career, because he can't pull himself out of his own confirmation bias. I'm afraid to say it, and Arch, this is because I looked at your profile. I love what you have up there on your profile with Mr. Schiff. He is an example of somebody who doesn't change his investment philosophy as the information changes. Hats off to BlackRock for at least appearing to change their investment philosophy as the information changes and as the market gets deeper, right? As BlackRock, Bitcoin's a $500 billion asset. When it was a $100 billion asset, they could afford to snuff their nose at it. Now is a $500 billion asset that's going to many trillions of dollars in valuation, in my opinion, valued using a US dollar shitcoin, by the way. But as going to many trillions of dollars, they cannot afford not to take notice. And my applause goes to the BlackRock people who have done the intellectual work required to realize what a beautiful asset Bitcoin is.
So regarding Peter Schiff, I no longer, well, I've long since stopped engaging with anything he's had to say, because I don't believe any of his criticisms are genuine. I think his stance is disingenuous. He has a vested interest in trolling Bitcoin for attention. And there was a time when I had a look at the days on which he gained a lot of followers. It's always when he's trolled the Bitcoin community for attention. And otherwise, if he was just talking about gold, he'd still have the same sort of 150,000 followers. But almost exclusively, he gains exposure for his business, which is about selling gold, and he's got various advisory businesses. And also gaining in followers for his Twitter account, almost exclusively when he trolls the Bitcoin community. So I made just a point not to engage with anything probably about 12 years ago. There was a point when I was trolling him back with a repetitive meme, because the nature of what he was putting out there was so repetitive. I literally just posted the same thing, perhaps even a couple hundred times. But that was about 12 months ago. And once I surpassed his account size, I just thought, I'm not bringing this guy any more attention, and no longer engaged with him.
Well done, buddy, because that is hilarious. Not even hilarious. It's actually very, very cool that you actually followed his follower account and had some sort of we could almost call it an algo. And here's the cool thing. Look, math doesn't lie, and if that was the way that it happened, then that's the way it happened. I just wanted to stress, though, people, please listen to people with alternative viewpoints of your own. You need to listen to the research that might tell you that you're going down the wrong path, because humans are, we like confirmation bias. We like to hear how smart we are by owning asset XYZ, when in fact, it's the person who tells you why you should not own asset XYZ that you need to listen to. And then if you can debunk their arguments or feel comfortable that your argument, your thesis overwhelms theirs, then you continue to own your asset exposure. This is, look, part of an efficient market. You know, I sort of went on the rant that ETFs are perhaps not as efficient as they should be. End of the day, bulls, bears, and pigs, right? Arch, bulls, bears, and pigs. Bulls make money, bears make money, pigs get slaughtered. Peter Schiff may have been in the last category, okay? And if he has a lot of followers but no assets under administration, we know where that ends up.
Okay, so let's take it back to what we were talking about before with regulatory uncertainty. There was a moment when the White House released a letter from, I think, President Biden that sort of came down, and then we saw a pretty quick about face from the US Treasury Secretary. That's Janet Yellen, isn't it? And she suddenly changed her view completely, and there was a growing and broad recognition that Bitcoin would be considered a commodity, perhaps maybe even one other cryptocurrency, so-called cryptocurrency, and everything else would be more or less classified as a security. And there have been some sort of comments that the CFTC would be a natural regulator of Bitcoin because of the letter from the White House. How do you guys see that playing out? Do you think that's a fait accompli, that the CFTC will regulate Bitcoin because it's considered a commodity, or is that still very much up for grabs?
Yeah, I mean, it's definitely going to be regulated by the CFTC. I think that was decided even before the letter from the Biden admin. One thing I will add is that the Trump administration, specifically Steve Mnuchin and others, were definitively anti-Bitcoin. So that administration, part of the reason why there is so much no regulatory clarity is from that admin a little bit. Biden has been more friendly, though not particularly friendly, but he wants what everyone wants. He wants more regulatory clarity because that's what everyone's asking for. The other thing I would highlight is that Yellen was definitively anti-Bitcoin, anti-crypto, anti-digital assets. But when everything happened with Luna and these other things, she gave a statement that was surprisingly knowledgeable of the space. So she definitely knows everything that's going on. She's opened up. She's learning more about the space. She was able to talk about the different types of stable coins that are out there in the market, whether it's algorithmic, fully backed, all these different options. So she didn't like jump on the bandwagon of people saying when Luna and Terra blew up, she was able to articulate why that isn't indicative of the broader space. So I say that is I view that as positive at the time. And again, the Biden admin basically telling all of the a huge chunk of the government to get in line and everyone work together to figure out how they want to regulate this market as being a positive thing. But that was mainly for the executive branch. So the parts of the government within the executive branch, which is the president's branch of the government. So that doesn't include the SEC and CFTC, but it's pretty obvious that the Biden admin kind of wants everyone to figure out how they're going to cover this space. And I'm thinking that we should have a good answer to that within the next year because Congress is putting together bills and different things to try and satisfy the requirements and set rules and guidelines for how this is going to be regulated.
Yeah, well
Greg?
said. Thanks, Arch. You know what? Well said, James. Nothing to add. I'm no expert on the CFTC versus SEC and the U.S. regulatory environment, so nothing to add there. I just want to bring it back, though, to some of the self-regulatory aspects that were happening within the Bitcoin ecosystem. A shout out to my friend Corey Clipston at Swan Bitcoin. That guy was part of the self-regulatory mechanism in terms of him calling out some of the Ponzi's at Luna and Anchor and Celsius. The man's track record is quite admirable. And this is, despite all the warnings from the Bitcoin, quote unquote, Bitcoin maxis, $60 billion was lost at Luna. That's not a rounding error. That's the same size of the money that was lost by Lehman Brothers equity holders. Now, the reality was Lehman was, much more of a debt story, DEBT story, than it was an equity story. But 60 billion is 60 billion. And there are people that I'm aware of that lost their life savings. And I'm not happy about that. What I am saying, again, is that the Bitcoin community's warning systems were spot on. Luna was a fiat Ponzi. It basically mimicked the fiat Ponzi, yet big hedge funds endorsed that. So yes, there's a level of regulatory benefits. There's no question. And until we have that, we have the Bitcoin maxis calling out these frauds. And God bless them, because you know what? I really do feel sorry for the people that lost a lot of money on Luna. But then again, and I just have to say this from having sat in a trading chair, the only way you really learn is to burn your hands. Okay. You can tell a young kid, don't touch the stove, it's going to be hot. But when do they really learn? You know, when they happen to touch the stove because they needed to figure it out themselves. So this is crazy. This 10,000 other altcoins that really add almost zero value, in my opinion, except to take away from the purest form of monetary store of value we've ever seen, which is Bitcoin. So why am I a Bitcoin maxi? Coming back to you, bro. I'm a Bitcoin maxi because Bitcoin is the only digital asset that solves the fiat Ponzi, pure and simple. And we need to solve the fiat Ponzi. Everything else is moot. Thanks.
Good points, Greg. But I don't think these fraudulent operations are going to go away when regulation comes in. But they will face the specter of law enforcement in a much more sort of overt way. So I agree with you entirely, obviously, regarding Bitcoin's position. But these fraudulent operators are not going to go away. Anyhow, I don't know how we got onto that.
I would come back and say that when people are making a lot of money and making money quickly, it's going to attract the type of personalities that want to take advantage of that and make money very quickly, even if it's through nefarious means. So by the success of Bitcoin and crypto, it has brought these people into this marketplace like Do Kwon and others.
There was no shortage of scams and bullshit pipe dreams during the .com bubble. I remember that distinctly.
Hey, Arch, why do you think it's so easy to work on Wall Street? That's why does it attract those people? Why does it attract those people? Because that's where you can get away with it as quickly as anywhere. Now, that being said, I spent 30 years on Wall Street and Bay Street, okay? I understand where my bread is buttered. At the end of the day, though, yes, but let's all probably agree. SEC enforcement action is still a very scary thing, and it brings positives to the table when you have an SEC enforcement action versus, oh, well, these people lost money, but, I'm not going to get thrown in prison for it. So I think that's what I was trying to say.
Hey, guys, this has been great. We've been running just on an hour. You got 5-10 minutes to take a few questions or comments?
Yeah, I have 5 minutes.
I do, for sure.
Yeah, guys, if anybody's got a question or a comment, just put your hand up now, make a request, and I'll bring you up on stage, and we'll hear what you have to say. Let's have a look who we've got. Okay, Vineet, you are up. Unmute your mic and go ahead with your question or comment. Okay, Vineet is not coming up. So we've got Mastermind. Go ahead, Mastermind.
Oh, I'm here, if that's all right.
Go, Vineet. Go on.
Hey, Greg, I just wanted to ask you, I know one of the things you had said in a podcast was one possible kind of way for fiat to squeak out would be long-term bond rates staying low while inflation's high, basically real yields being low all the time, right? It seems like we're in that now, and it seems like that could keep going because a lot of companies just need to hold on to bonds because they can't have too much cash in like savings account in banks, or like they just don't want to put their money in. They're not orange pilled, so they don't want to put their money in Bitcoin. Stocks and things like that are maybe too risky at time periods. So it seems to me that it's plausible that real yields stay negative for a long time. I don't know if that thesis is outrageous.
No, it's not outrageous at all, especially if you invoke yield curve control. But I don't want to take away from the great work that Luke Roman has done on this subject. I'll just direct people towards the IMF playbook called financial repression. Okay. Basically, it's where bonds are repressed because you need to let the economy grow faster than, so inflation needs to be higher than the average coupon on the bonds so that you can skate yourself back on side in a debt to GDP ratio that is greater than 120%. So it is a mathematical outcome, but man, oh man, does it ever make bonds below, right? So Be careful. Just understand that it is one of the, and it's actually documented as the IMF playbook, is how totally indebted fiat countries skate themselves back on side from this debt DEBT spiral. I don't think it holds water long term. Short, in the short run, certainly anything's possible. We are in a dangerous position, people, and that's why I love Bitcoin as insurance against the inevitable debt spiral bursting. Not here to cause alarm. Bonds are a fiat contract. Various countries have different likelihoods of defaulting. The USA certainly is at the lowest point on that risk ladder, meaning it's got the highest likelihood of surviving the longest, in my opinion. So don't panic. Just understand what a bond is. It's a fiat contract, and you might be repressed. Look up the term. You don't want to be the sucker at the table, because if you don't know who the sucker is, chances are it's you, right?
Mastermind, why don't you go ahead with your question or comment?
Hey, thanks, guys. And just coming to you from the fiat mine right now. I guess my question is about BlackRock and Bitcoin. A lot of people are excited. Some people are worried about it. Obviously, BlackRock own Bitcoin, but don't work. But I guess my concern would be that really inopportune time, and that maybe they can really dump the market with their trillions of dollars. So just wondering if anybody had any comments on that.
You broke up, so I couldn't really hear the full question. But I mean, it's just another avenue for people to get access to the space. So just because, I mean, if they're holding assets and they're custodying assets so that their institutional investors can access to Bitcoin, I mean, whether they get access through BlackRock or they get access directly, I don't think that necessarily creates any added risk. They're still a market player in the space. So that's the way I look at it. I don't know if I missed other parts of your question and didn't answer them, but I'll let Greg comment.
Yeah, thanks, James. Well said. Look, the reality is that Bitcoin has weathered a pretty powerful storm in the last 6 months anyway. And that's good. When you're an institutional allocator, you have limits as to what amount of a given asset you can own, right? You have risk guidelines that are set up according to the liquidity of that, how much you need to put 1% of your portfolio in, how much that would correspond to owning of the entire market. But here's the truth. Look, Bitcoin weathered the Luna debacles. It weathered Celsius. It weathered, when I say weathered, it traded 24/7. It traded orderly. There were gaps down, but they weren't from 20,000 down to 2,000. There was liquidity 24/7, never closed. And then it all comes out that Elon Musk was one of the sellers as well during this downdraft, this drawdown. And guess what? The market just kept tick-tock, next block, chugging along. As an institutional allocator, I would look at all that and say, wow, the liquidity is actually a lot better than I thought it was. And this is a $500 billion asset class that will appear in the top 20 of any equity index anywhere if it was a single name equity. So you got to understand how these allocations take place. You could say, oh my gosh, BlackRock's going to dump their whole stack. Well, guess who's frequently on the other side? Another institution that needs to get into the market. And this is what makes fluid markets function well. I think Bitcoin is far more fluid and far more liquid than people give it credit for. And it trades 24/7, which is, itself a beauty. But this is how things evolve over time. 13 years, tick-tock, next block. The big money's getting more comfortable with it. Thanks for your question.
So my expectation is that as larger funds move into the Bitcoin space, that we'll see not only price appreciation, but along with that, much more stability in the price. Would you say that's a fair comment, Greg?
In a nutshell, no. I think you'll see gaps up, not gaps down. Because again, just do the math. Let's take those 5 funds that James eloquently, or maybe it was you. You said 35 trillion. The math I had was 40 trillion. Okay, 40 trillion. Let's say they put 3% allocation across 40 trillion. Okay, that is $1.2 trillion. Okay, Bitcoin currently has less than a 500 billion or 1/2 trillion of market cap. If they need to put 3% allocation and they all decide to try and squeeze through, more marshmallows in the piggy bank all at the same time, well, guess what? You actually get face-ripping rallies rather than face-ripping drawdowns. Volatility works in both directions, Arch, and one of the great things is there's a Bitcoin. Well, you can argue whether it's great or not. I actually always view the ability of having shorts in the market as very important to a smoothly functioning market. So to the extent that this Bitcoin ETF that exists in the USA, which is cash settled futures, is a bad thing, there's an opposing side that says, hey, guess what? Those shorts, those guys that were short Bitcoin through the ETF and futures, they provided a stabilizing mechanism when all this trading was taking place out of Luna, out of Celsius, etc., that I mentioned. In the hedge fund business, Arch, you probably know this, but the funniest thing is people get short the index and they keep single name exposure, right? That's how they tend to manage their risk. And then what happens then is you're short Bitcoin and you're long shitcoins, or you're short Bitcoin and you're long Bitcoin miners. And then all of a sudden Bitcoin starts to rally and you need to cover your short, and your single name isn't rallying in lockstep because the big money is coming into the index. This is part of the ETF conundrum. So it could be volatility to the upside, my friend. I'm not calling it. I don't necessarily want it to happen, but it could actually be volatility to the upside as far as I'm concerned.
So I was referring, well, I didn't make myself clear, but I was referring specifically to not the process of funds entering and the process of price appreciation, but once all the funds were in, Bitcoin matures. I expect volatility to actually reduce as Bitcoin
that's 30
matures.
Years.
Yeah.
That's 30 years down the road, brother. That's 30 years down the road.
You think it will take that long for...
Oh, yeah, man. It's not even close. Okay, 30 years down the road, we'll be looking back at 2000 and wherever we are now, 2022, and we'll be like, I probably won't be around, knock on wood, but my kids will be. You remember Dad was fiddling around in his office with this thing called Bitcoin that, you remember when it was trading at $25,000? Man, we are 3 orders of magnitude higher than that now. Maybe Dad was on to something. I always thought he was a crazy old fuck, but maybe he wasn't as crazy as we thought, right? So, do your math. It is only a matter of time. And yeah, it'll take 30 years, Archie. It really will.
I really appreciate that. Do we have any more questions? Look, I've taken up quite a lot of your time so far. James, sorry, did you have anything to add to that?
Yeah, I was going to add 2 things. I'd say one, depends on the type of people investing, right? If they're coming in, they're taking Bitcoin off of exchanges, off the ability to trade, that lowers the amount of supply or the ability of Bitcoin that you can buy on exchanges. So theoretically, that would likely talk about what Greg is talking about. It will increase volatility because when you fix supply in something, that's the changes in demand have a much larger impact on price. Whereas if supply can't change, that's when you get less muted impacts on price. The other side of this is if these people are coming in, a lot of this money is going to come in with, like Greg said, a 3% allocation, 1% allocation, 5% allocation. I think you could see a smoothing of volatility because you'll see more people that are going to be selling as it rallies and buying as it dips to maintain that allocation when they rebalance their portfolios every quarter, which institutions and advisors are going to be a lot more diligent about doing than many people currently investing in the space.
That's an interesting counterpoint to Greg. Before we finish off, any final comments?
Well, I'll just take it before James give you the last word. It's great to learn from you, sir. I really appreciate the chance to be up here. You know what? All I know is this is the best asymmetric investment opportunity I have ever seen in my lifetime. The wrong answer is to own 0% allocation to Bitcoin. Congratulations to BlackRock for finally doing the math to understand that the world needs exposure to the best asymmetric trade opportunity and investment opportunity I've ever seen. Now, the problem with that is the people that really need it live in third world countries, and BlackRock might be getting in before people in the third world countries had enough time to do their own math or accumulate their own amount of Bitcoin. So there's always positives and negatives. Always, though, remember, do your homework. understand math. Math is truth. Bitcoin is math. Bitcoin is code. Do it for your children. If you're too dumb to do it for yourself, do it for your children. Thank you very much for having me, guys. I really appreciate it.
Thank you, Greg. It's always a pleasure. James, over to you.
Great talking with you, Greg and Archie. Everything, I echo your same sentiments. The one thing I'll leave you guys with this: all of these asset managers, all these custodians, if they don't have explicit plans to offer crypto custody or get involved in the space or something for their clients, I can pretty much guarantee you that they're talking about it on the back end. I mentioned earlier on in the show that Schwab just launched a blockchain/crypto thematic ETF. BlackRock did that a few months ago. A lot of other issuers have done that. So everyone's kind of inching into the space, and eventually most asset managers, most custodians are going to have to offer some path to get access to the space, whether it's Bitcoin only or crypto/digital assets in general. It's going to happen in the coming years just because people have to compete and they don't want to lose customers who likely want access to this space. So the customer is always going to be right. And if a company can make money doing it, they're probably going to do it.
Thank you very much, gentlemen. Really a great pleasure to have you on at such short notice, as it always seems to be. I just get these urges to talk about certain topics as they come up. And thank you very much for making yourselves available and putting on a great show as well. I really appreciate it. Thank you.